What's up, everybody? My name is Joe Brown. This is the Heresy Financial Show. And as reported by Bloomberg recently, a historic cascade of defaults is coming for emerging markets. This is because the dollar, on the screen behind me, the dollar index has been getting so strong recently, stronger than it's been in years, in over 10 years. It is making it more and more difficult for emerging markets to get dollars. And so if it's harder and harder to get dollars, it means it's more expensive. That means it is starting to bankrupt some of these emerging markets, and it's only a matter of time before that spills over into developed markets. Ready? Let's dive in. A few months ago, I was speaking with Greg Foss. He's a fantastic follow on Twitter. He's always talking about bonds and Bitcoin. If you don't like Bitcoin, just ignore the stuff he says about Bitcoin. Very smart, long career here. And I was talking with him about the dollar in emerging markets because he pointed out to me, hey, look, every time the dollar goes up, every time the dollar spikes and has a huge rise, you start to get problems in emerging markets. They just can't afford to get dollars anymore. And that's exactly what has started to happen now. We are seeing a cascade of defaults potentially coming for emerging markets. Take a look at these countries: El Salvador, Ghana, Egypt, Pakistan, all vulnerable. And it's not as if there's just countries that are vulnerable. We are already seeing countries like Sri Lanka who have already stopped paying foreign bondholders this year. And in fact, Reinhardt recently said in an interview on Bloomberg that the low-income countries, the debt risks and debt crises, they're not hypothetical. We are pretty much already there. I mean, just take a look at these government bond yields right now. El Salvador, 31%, Ghana, 17%, Egypt, 13%, Argentina, 20%. Very, very expensive debt as the dollar gets stronger. And yes, just in case you're wondering, this is relatively recent. This isn't the way that it's just always been. If we take a look at the number of emerging markets that have sovereign debt that yield more than 10 percentage points higher than similar maturity treasuries, that indicates that investors believe default is a real possibility. That number has more than doubled in the past 6 months. And it's not like these are tiny nations either. If we take a look at collectively, those 19 nations, they are home to over 900 million people, almost 1/8 of the global population. Now, I'm really glad that this Bloomberg article pointed this out, that the crises like these, the real risk here is that they can create a domino effect known as contagion. Basically, what's going on here is that you have an interconnected global financial system. You've got large banks that are interconnected in all markets around the world, whether from business or just from their balance sheets, that if something crazy and unexpected starts to happen, it could bleed over to their balance sheet in a very bad way. Why is this? Well, it's because the way that balance sheets on large banks are constructed is using something called relative value trades. So they buy and they short something that have a relative value to each other that should be almost identical. So both things should go up together and both things should fall together. So this would be similar to you shorting Class A shares of Google and buying Class C shares of Google. They're both shares of the same company, so they should move up and down together. And so if you buy one and short the other, your losses and your gains on each are going to offset each other as the shares move. But if you watch the arbitrage take place between the two, sometimes they move a little bit different. So sometimes you might get a little bit of a bigger spread between the shares. So if you enter into the position right there where there's a bigger spread, then you can close them out when that spread converges, close out that trade, and you've basically entered into a risk-free trade. The problem is sometimes unexpected things happen. So they try and model this and say, hey, we're going to use a model that looks back at all the unexpected things that have ever happened before and make sure that we're not overextending ourselves so that if something like those happen again, that we'll still be fine. What they overlook, though, is that every time in the past something unexpected happened, it wouldn't have been in the model prior to that, because at that point that it happened, it was unexpected. It had never happened before. So now we are using that past data, but what if something happens again that is worse than what has ever happened before, or different? That means by nature, you cannot model the unexpected because it's never happened before. And so when you see something like this take place where, hey, the Federal Reserve is tightening more than most investors ever thought they would. It's making dollars more expensive than many people thought they could get. That's making debt defaults more and more and more likely for dozens of countries all around the world that contain hundreds and hundreds of millions of people. This means that there are banks that own this debt that could get defaulted on. So you have a bank that has debt that could get defaulted on. That means a trade could do an unexpected thing. They have to close it out. Well, once this starts happening, you get contagion spreading, you get losses start to appear on these balance sheets. Why is that a problem? Because most of these globally systemically important banks have balance sheets that are dozens of times larger than their entire market cap. This means that a 5% loss on the balance sheet could wipe out the entire market cap of these banks. That's basically like if you went into your brokerage account, leveraged up with margin, so that if you had a 5% loss, it would wipe out your entire net worth. That's probably not the wisest position to be in. You don't want to be that leveraged up. And the only reason they are is because they look at their trades as being risk-free, but they're only risk-free because what they're saying can never happen has never happened before, but what if it happens next time? To be clear, nothing like this has happened yet. So we are still waiting on the sidelines to see if this gets bad enough where defaults do start to sweep across the planet. But if things keep on going the way they are, it's really only a matter of time. If the dollar continues to get more expensive, if we have more supply chain disruptions, if we have more wars and rumors of wars, if we have more indications of the world not resolving these problems, but starting to see them get worse, it is more and more likely every day that we see debt defaults sweep the planet, which would result in major losses on banks' balance sheets, which would then result in financial contagion across the global financial system. And that's something that I think would probably prompt a turnaround and a pivot from central banks, at least to bail out the financial system, if not bail out everyone else as well. Hope this helps. Let me know if you have any questions in the description below. And as always, I really appreciate you guys. Thank you so much for watching. Have a great day.